Hello, YouTube. The Bears are wrong, and here's exactly what we want to do right now. First of all, we don't want to laugh at the Bears, even though they are probably crying today because they were so vocal yesterday. We want to remind ourselves that we're closing out the worst month of the year for the S&P on average over the last 30 years, but we're about to close it. Reminder, we're going to close out the weekly, the monthly, and the quarterly chart today. So right here, we're looking at the daily chart, but we talked extensively about the weekly chart. Right now, it's down by 7 cents. And we talked about the monthly chart, which needs to get back above 433 to reclaim that failed breakdown. So what's going to be so important for us to start off with is that we're not going to see bullish price action on the weekly or the monthly without it seeing happening on the daily first. So right now, we are exactly on yesterday's high of the day. We went through that same exercise yesterday where we looked at the high from Wednesday at 427.67. We back tested and bounced it. So here's what you want to do right now. We're going to look at a 15-minute chart, and we're going to ask ourselves whether or not that same thing that happened yesterday is setting up right here. We're a little bit below it right now. We can know we got above the key area. We bounced. We're finding support. And now we're not quite sure. So what I would note is that if we continue to march higher, we do have a bullish pattern setting up inside of here. It's some kind of inverse head and shoulders. And we have a low, higher low, and a higher low. So I'm watching really closely what happens between 430 and 434, or roughly a 1% move. So now that we understand what we want to do right now, you want to understand that it is okay to be wrong. It is not okay to stay wrong. So if you're bearish, and we know that gap ups are for selling, but what happens usually on a gap fill? Normally we'll get a buy. Normally it'll reverse from there. So if you're bearish, this might be a good opportunity for you to what? Take advantage of the liquidity to maybe take a little bit off the table. We got one nasty cut, a dead cat bounce, and then a second nasty cut, or basically a dance from our 78 down to our 61% retracement. So I'll be watching very closely where we close out the day, but here's the two levels I'm really watching for. Our algo is thinking that this looks like a pretty bullish setup. Again, you can join us for a 14-day free trial at thealgo.com if you want to trade with me, Justin from YouTube. But what this really means is that the daily chart is starting to flash some signals. The candle's not closed out yet, but on the weekly chart, that back test of 430 is a back test of last week's low at 429.99, which means if we back test 430 and then we also reclaim 430, that's the start for the weekly chart to look bullish. It is not the finish. We need to start actually forming higher lows and higher highs, which is the exact same thing we did here on the daily chart. Low, higher low, high, higher high, higher high. That's what I mentioned yesterday. So we need 3 candles to form a pattern. Right now, we just got one. We got a low and we got a lower high. So not good enough. It's not bullish. At best, it's a failed breakdown. Let me just go back here. I got my lines. Cool. So the weekly chart is probably going to need a few candles to print higher lows and higher highs as we're advancing higher to signify that we're actually going to get a weekly trend change. We're bouncing off support, but that's all we're doing. And then because we're also closing out the month and the quarter, well, we're on track for the worst month going all the way back to December of last year. That's right, 2022. It's going to be the worst month since then. And the reason why that's significant is because this is not a failed breakdown. It's just a breakdown. We broke the chart. We lost 433.01, and we're currently below it. So the PCE number that came out today is the catalyst I was looking for us to reverse. We're going to have to see this 430.25 area reclaimed. That's what you want to do right now. And if we start making progress up towards 432, which is going to be our 431.76 high that we formed back in August, that's important. And then notably, if we're back above 434 at the close on Friday, which means today at 4 o'clock, I think it's time to start being receptive to the idea that you could be wrong. We got a few more things to go through, but I'm going to ask you for a huge favor. If you could please consider smashing the thumbs up and subscribing to the channel, I would really appreciate that. Thank you for your support ahead of time. So let's have a look at the rest of the data that drove the market today. We talked about what can happen in September, but if we briefly look back at the month of October for the last few years, what do we know? Well, September is terrible. October is great. We look back in time here. We got September being terrible, October being great. Let's go back one more. We got September and October for consolidation. Then we rally into the end of the year for December. So that's the 3 times we went through this exercise before. We looked at 2011. We looked at 2008. We looked at 1999 to 2002. A lot of the same. We're 2 points higher. We're out of extreme fear. We're only into fear now, but this has to make progress. This is not good enough. Why? Because we're buying fear, selling greed, but being at low end of fear is not really good enough. So what drove the market today? Well, it's pretty simple. GDP in Great Britain is actually better than expected, so no recession in sight. And then we note that CPI in Europe actually went almost down to full percentage point from 5.2 down to 4.3, and even came in with an expectation that missed, which is bullish. Lower inflation is good for stocks. We can look forward to America. At 8:30 this morning, we got both numbers. The headline core CPI came in year over year at 3.9. That's the number I talked about yesterday. And then the core CPI came in with a surprise miss at 0.1. This is all really good. And we can note the S&P is attempting, keyword being attempting, to push off that 430 area. And the reason why this matters is because the dollar is down, but with a failed breakdown. We note VIX is down by 7%, which means the market is more calm, cool, collected than before. The US 2-year note is now down, and the 10-year note, last time I checked, is also down. But it's not down enough. When we look here to our weekly chart, I mentioned two things yesterday, if you remember. I mentioned I need to see us back below 433, but that's a tall order for one day of price action. The other thing I mentioned was that I would like to see us back below 4.509 for a weekly failed breakout. We have a weekly failed breakout here, weekly failed breakout here, which led to a decline, which led to a decline. And if we can decline on this line, that is what we're likely going to need to see for the S&P and the NASDAQ to actually rally. As a reminder, the reason why this is important is because when yields go up, and last time we checked in here, this is a screenshot from the beginning of the month, we were at roughly 4.45. Well, right now we're at 4.54. So this black line's gone a lot higher and the red line's gone down, which means that if we're going to see the red line go up, or the NASDAQ, which tells us right here, the NASDAQ, we need to see this line get a stomp. We need to see it eventually back below 433 to confirm the move. So this could be the start of it. Nice headlines out of Europe, nice headlines out of America, but it might not be 100% enough. The government is likely going to be shutting down. It seems imminent right now in America. So what I'll be watching for is going to be what happens with these other key dates. These other key dates are important because when we have a look here, we can note that there's not really that many of them, but we do note that we got CPI, jobs, retail sales, PCE, the Fat Bear Week, which I'm not even sure what that is. It's where they guess on how fat bears are, I guess. It was some kind of joke. And then the Fed meets on November 1st. So in the next 30 days, if we don't get more data, the data that we got like this week and today is like, it's perfect. This is exactly what we want to see. Stronger than expected growth. We're still going to get inflation numbers out of the rest of the world. So I'm cautiously optimistic. Keyword there being cautious. As we look at the heat map, we're seeing short-term rotation out of energy back into other things. If we look at the last 1 week, we note that utilities are down, which are usually a safe haven, and that is usually supportive of stocks. So we're not really seeing a lot of a big bid, but we have to remind ourselves that we're closing out the monthly and the 3-month as well. Whoa, it's pretty red. That's right, Mr. Red making an appearance. 3 months, it's clearly mixed. There's a lot of rotation. So again, we can look at the heat map for a visual and what's happening on the chart. We're just trying to understand what happens. Finally, so if we now look here to the S&P and we look at our weekly chart, I've mentioned that we're going to need to see a few candles of higher lows and higher highs or failed breakdowns. But right now we have a high, lower high. That's a double top. It's a couple cent higher high, lower high, lower high, lower high, lower high, lower low, lower low, lower low. So that's clearly bearish. We're going to need a few weeks for us to flip bull. And as we look here to the end of September, cut it nasty, dip it down to close a month out at the low. And then by roughly a third of the way through October, we form a marginal lower low and then we advance. So if we're going to get some kind of chop, I would look for that exact same thing we looked at here on the weekly chart, where we get a failed breakdown if we're going to go lower, because what this implies, that seasonality chart, is that we're going to be getting a monthly lower low. So if we get another monthly lower low, the only way that it's bullish is if it ends up being a failed breakdown. Going down is bearish, but failing to hold it actually means that there was no follow through from the bears. So it's really important. We do not claim victory yet as bulls. That's what we want to do. Maybe we're getting discounts right now. Maybe we want to take advantage of those, but it's not time to say that the all clear is here. We're going to have to see a trend change on the weekly and on the monthly. So if that monthly chart's going to play out, there's your low, higher low, higher low, high, higher high, higher high. What would that mean? Bullish on the monthly if everything plays out into the end of the year. So with that said, thank you so much for tuning in. If you want to watch the weekend deep dive, that's now queued up here on the left-hand side. If not, come hang out with us for the final hour, where we're going to talk about whether or not this is a trap for the bears. That's me, Justin, right there. I look forward to seeing you guys at 3 o'clock for the final hour. Thank you so much for tuning in, and I'll see you at 4 o'clock, 3 o'clock, sorry. Thank you.